Hello, everyone, and welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Nugwa Haruna. Thanks for tuning in during Investor Education Month here at TD Direct Investing. We're dedicating October to helping you build the confidence to invest and trade. If you're like many beginners, you might find it a little intimidating to get started investing, and you might have some reservations holding you back. Well, today's session is going to address some of the top questions you might be too afraid to ask. One of the most thoughtful personalities in investing will share her answers to help you get going. But before we dive in, I want to quickly highlight some of the features of our broadcasting platform to help you get the most of your viewing experience. So I want to first highlight the box that's right in the middle of the screen there. You have the ability to move that around. You can maximize that. You can minimize that as Simran and I carry out our conversation. You can also mute that if you want some moments of quiet. Now, to just learn a little more about our guests today, you're able to check out the resources and links that are on the left side of your screen there. So check out a little more about the Girls That Invest podcast and social media channels. And if you want to see some of the previous conversations that we've had with Simran, you're able to check those out as well. Speaking about past events, you have the ability to check out any webinars you may have missed by clicking on the Inside Investing box that's at the bottom left of your screen. I would encourage you to follow our social media channels. You're able to see our YouTube and Instagram QR codes there. So scan those, follow us to find out what more exciting content we have for you. Now, as I mentioned, the month of October is about Investor Education Month, and it's all about you. So if you want to see some of the great guest speakers that we have, register for our upcoming events in the box that's highlighted right now on your screen. Now, the final and the most important box today I want to highlight is on the right side of your screen, and that is the question and answer box. If you're looking to participate in our conversation today, type in your question there, and I'll be happy to address those questions to Simran. If you happen to be logging on YouTube, I would encourage you to check out the description section there. You are able to register and join the live conversation. All right, with that being said, let's welcome our guest speaker and get our conversation going. Joining us is Simran Kaur, founder of Girls That Invest. She stars in one of the most popular investing podcasts in the world with over 10 million downloads. She's also a best-selling author and was named to Forbes 30 Under 30 list. So Simran, you're a favorite on our program, and so thanks for coming back for another chat.
Thank you for having me. I'm so excited to be here.
Yeah, it's nice to see you again. I remember we ran into each other last year at a conference, so it's really exciting to have you back on the show, and I'm looking forward to a great conversation. So speaking of which, Girls That Invest has really taken off since we last spoke about a year ago. So can you fill us in on what your work is all about and what's up next for you and the team?
Absolutely. Girls That Invest, we're the world's largest investing education platform for women and minorities. We do this through our podcast, as you've mentioned, our book, and our social content and newsletter. And what's been happening since the last year is we've really just focused on growing our platform. We now have 500,000 followers on Instagram, hundreds of thousands of followers on our newsletter. And we're making sure that if you are someone that says, I would like to start investing, but I don't know where to begin, that we're a free resource that's available to help.
I want to mention I am one of those followers, and you have really great content on there. So anyone who is interested, you can check out, as I mentioned, the Girls That Invest social media channels by checking out the resources and links on the left side of the screen. All right, so Simran, why did you want to focus on helping women in particular get comfortable with investing?
I think the number one reason was when I was beginning my own investing journey, I felt really, really uncomfortable because I just didn't know how to get started. And I think when you think about the types of people that you've had in your life growing up, for me, it was the aunties I had, the older women in my life, and the life that they could live was very restricted by their financial capabilities. If they had a partner that said, look, this is what we're doing, if they disagreed with them, they'd often get told, well, look, I'm the breadwinner, therefore I make the decisions. And so very early on, I realized if you've got financial freedom, you've got power to live a life that suits you. And for women, for minorities, for anyone that doesn't quite feel represented, that's really important to have that freedom.
And you know what's interesting is that, to your point, women are typically less confident when it comes to investing in terms of their investing ability. But a study by Fidelity actually showed that women investors tend to earn better returns than men, up to 1% more. So it's really great that you're out there educating women for them to understand the potential when it comes to investing. All right. So, in your experience, what's the biggest reason why young people don't start investing sooner?
I think the biggest reason we've seen when we interviewed our community, we asked them, look, what's stopping you? There is information out there. We found that there was a huge misconception that you needed to be really wealthy and that you were someone that had to know exactly what you were doing to get started. I think the biggest misconception that we found is people feared making a mistake. They didn't feel like they had enough knowledge. And so if you're unsure how much you need to start with and you're unsure how to do it, of course you're going to, hold back and think, well, what if I lose all my hard-earned money? No one wants that.
Yes, that's very true. Nobody wants that. All right, so let's have a little fun before we jump into, more of the back and forth, because we want to get to know you a little better. So we're going to do that with a lightning round. I'll ask you a few short questions, and you'll share your take in as few words as possible. Are you ready for this, Simran?
I'm ready.
All right. So when did you first start investing?
I started investing when I was at university. It was around 2015. Is that enough words? That's too many words.
No, it's okay. You're doing good. Yeah, I love that. So 2015, almost 10 years ago.
Yes.
I think what would be fascinating is if we potentially looked back 10 years ago and looked at, let's say, market returns over 10 years, we'll potentially see a lot of dips. We know COVID happened, that huge market dip. But then we'll potentially also see that markets historically are positive in the last 10 years. So thanks for sharing that. Okay, next question. What was your biggest fear or misconception about investing?
Oh, that I needed, I guess it's kind of the misconception most people had was I thought I needed a lot of money. I thought I needed the boat and the house and everything to start investing, which obviously is not the case.
Right. I don't blame you. That's what you see on TV, right? When you think about an investor, it's always someone with the flashy cars. And so I don't blame you. All right. Question number 3. What's one thing you wished you knew about investing earlier in life?
I think it would be how simple investing is and the idea of an index fund. And I'm sure we'll talk more about what that is and how it works, but just it's not difficult to be a diversified investor that actually makes returns over time in the long run. I thought it would require a lot more information and research and reading than it took.
All right. Okay. Next question. What would you change about your investing journey if you could go back in time?
This is really cheesy, so please don't blame me. But I honestly would have started earlier. And I think that's what we say about everything. It's what we say like when we start working out. We're like, God, I wish I had took care of my body earlier. But yeah, I just wish I had known this information, when I was 15 or 16. That would have been amazing.
Yeah, I love that you put it that way because time is always your friend. And so we'll talk a little more about that and taking advantage of time. But to your point, time. I wish I'd taken advantage of time. All right, so we have our last question for you. What's your biggest investing success?
About 5 years ago, I had invested in a company that I noticed it started to grow a cult-like following. And I felt like the company's shares were going up, not because of the actual, product or service, but because of the founder, which was really interesting. And it went up 400%. It did amazingly for my portfolio, and it ended up helping me actually purchase my first home. So I was able to invest, grow my portfolio, and then put down a home deposit. So that was huge for me.
That's absolutely amazing. So thank you for sharing that. It's really great to hear great success stories like that. Now, keep in mind, not everyone will experience the 400% return on their investment, but it just shows you that there are success stories out there, more realistic success stories that you might see on social media. So thanks for sharing that, Simran.
Yeah, I just wanted to make it very clear though, never had another one of those. That was a very lucky investment.
There you go. Exactly. So investing shouldn't be looked at as gambling, right? Oh, I got it once, so it's going to happen again. So yeah, thank you for sharing that. Okay, so we're now going to jump into the heart of our conversation, which is answering the questions that beginners might be too afraid to ask. So the first question on our list is, can I invest if I don't know a lot about money and financial markets? So what do you think, Simran?
I think it's something that I think a lot of us think, well, if I want to become an investor, there's probably like a bachelor of personal finance that I need to take, or a bachelor of investing that I need to take. Now, I'll tell you now, a lot of our community members have a bachelor's in economics. Some of them have become investment bankers, and they've come to us and said, our degrees never actually taught us about personal finance or investing for ourselves. And so that really helped the people that think, oh, I need a lot of information. You don't need to go away for 3 years to learn how to start your own investment portfolio. If you want to begin, there are simple tools, simple resources, and even just being here for this webinar, like by the end, you will have a good understanding of how to get started, what your risk tolerance is, and how to, look at different portfolio options. So it's not as hard. And I think the goal of today is to make sure you realize that by the end.
I love that you mentioned that, Simran, because I also have a degree in economics, and I can say that in terms of my investing knowledge, I didn't really apply it directly, right? You know everything about financial markets. I still didn't feel like I had enough knowledge when it came to investing in itself. So that degree, saying I need to go back to school to learn about investing may not necessarily help you get started. So it is important to realize you don't need to be an expert to start investing. So thank you for sharing that. Our next question is, so investors, if we don't want them to know everything about investing before starting, what's a simple way for them to get started as they learn?
I think the best way to get started, because if you open up a account and you go and you look on the website and you see all these different options and different companies and bonds and funds, it can seem really overwhelming. And I guess the question everyone has is, how do I pick a winner? How do I know that this company is not going to completely disintegrate in a few years' time, or this company is not going to have, a scandal with the founder and the shares are going to drop? And the truth is, no investor and no professional can predict the future of where an individual company's shares are going to go. And that's really scary, but that's the truth. So one of the best ways to get started, which diversifies your risk, because maybe some companies do well, some don't, is what we call index fund investing. That's putting all your or some of your money into a basket filled with lots of different companies. And so some may go up, some may go down, but your risk is diversified and you're investing in one asset rather than many.
All right, that's amazing. So when you mention index investing there, when it comes to investing strategies, investors can apply different kinds of strategies. There's an active strategy where you're constantly checking the markets, and index investing is more passive, right? So a way that a beginner could potentially check out, because it means they don't have to actively try to beat the markets, because index investing seeks to track the performance of the markets. So
Exactly.
all right, so let's move on to the next question that a beginner might be too afraid to ask. And that question is, can I afford to invest? We know a lot of people are afraid to talk about money. So what would you say to someone who's unsure if they have the money to invest?
I think one of the biggest misconceptions is that you need like $10,000 ready to invest. And the truth is, in this environment, especially if you're at the start of your financial journey, you've just graduated, or you're a few years in, or you're still paying off student loans, there's a lot of things that can happen that mean that you may not have a lot of cash flow, a lot of money coming into your account to invest with. That is okay, because now we have what's called fractional shares. And that means that you can put as little as $5, $10 into an index fund of your choice, into companies that you believe in. And as those companies grow or drop, your $10 will go up and down just as much. So you can put a bit in. You don't have to wait until you have a large lump sum. You can also pay yourself first. And I think that's been probably the biggest like eye-opening experience that I had. I remember when I started working, my old lecturer had said, when you graduate, keep living like a student. Don't go out and buy the nice car. Don't go out and increase your expenses. Pay yourself first. So every time you get your paycheck, 10% or 20% goes away into a separate account, and then you invest or save that over time.
Yeah, I love that you mentioned that, because paying yourself first, I think when you mentioned 10%, 20%, think about it when you're tipping. So when you order something, it's $50, you're tipping $5, right? If you utilizing something like partial shares that you mentioned, if you wait, say, till the end of the year to take out that 10%, let's say you're earning 50,000, 5,000 seems like a lot of money to take out as a lump sum. But if you take advantage of things like partial or fractional shares, and let's say you're doing the $10 you mentioned, or let's say $50 biweekly, that seems more reasonable. And then over time, you could potentially build that portfolio. So thanks for sharing that. All right, so some young investors carry debts. So things like student loans, car loans, we have mortgages, credit card payments. So how can they decide whether it would be better to pay down debt or invest money instead?
This is such a commonly asked question, and it makes sense because, like, I think we all have a little bit of debt here and there, and if we don't, that's actually an incredible privilege, and we're very lucky. But whether it's your car loan, your mortgage, people say, well, Simran, if I have, and let's say I get a bonus of $5,000, should I be paying down my mortgage or my student loan, or should I be investing that money? And I always love using the 6% rule. And the 6% rule is this idea that if you think about how much the share market returns annually over a long period of time, now, this is an annualized return. So some years it goes up 20%, some years it goes down 10, 15%. But if you average it out, we're looking at about a 6% return. That's nice. And that's actually a little bit of a conservative number, but we like being a bit conservative. So if you have $1 and you invest it, it goes up 6% hopefully over time. That's amazing. But we want every single dollar of ours to work hard for us. So if you have debt, that is more than 6% on its interest rate. So let's say often car loans, credit cards, some mortgages, if you bought a home, in the last 2 years and the mortgage was quite high, interest rates more than 6% on your debt, you would rather use that $1 to pay that down, because that is a better use of that dollar. And so if you have a student loan that isn't at 6%, which is many of us, that's a good thing. You don't need to pay that down before you start investing, but we want to get rid of the high loans, because it's kind of like pouring into a bucket with a leaky hole in it. We want to close up those holes so that when we start investing, our money bucket grows.
Yeah, I love that, right? Because it's to that point of, having something where you're carrying a huge balance. And if it has a high rate, you want to think about compounding. This was something we talked about last week. And so we talked about compounding. So you can either take advantage of it or it will take advantage of you. So, so doing those comparisons is a great way to see, if you're going to end up more in the red as opposed to getting a head start. All right, so let's move on to the third question that a beginner might be too afraid to ask. And the question is investing too risky for me? So what do you think about the idea that investing is inherently high risk?
I think that it comes a lot from the misconception. Like, if you think of an investor and you lean on what we see in, mainstream media, so movies like Wolf of Wall Street or The Big Short, you think of like people running around in suits, getting really stressed, like their hands on their heads, like on the trading floor. And that seems really risky, really intense. And think, gosh, like, I don't want that. Like, I want to grow, generational wealth for my family, but I don't want to take on this high risk, high reward stress. I think the misconception is that all types of investments are like that. But I think of investing as a spectrum of risk. And you can change your spectrum of risk based on your asset allocation. So that's a big jargon term, but I'm so excited to talk about it because asset allocation is deciding, well, I'm going to put some amount of money in higher risk items, some in lower risk items. And depending on how much I put across those, I can have less risk or I can be more risky. But it's not a one size fits all approach. Someone that's maybe younger and has less responsibilities might be able to take on more risk because they're investing for the next 40 years. So they can ride out bumps. Someone that's close to retirement wants to preserve their nest egg and won't take on as much risk. So it's all down to how you allocate your portfolio.
All right, so speaking about some of the riskier assets, we know that young investors are typically presented with a lot of risky assets like crypto and meme stocks and social media. You can't seem to get away from those. So while those might work for some people, they don't always work for others. So how would an investor figure out how much risk they're actually comfortable taking?
Oh, I think what you would probably want to do is look at an investor profile survey. You can do that online. There's so many options available, especially through this platform. So there's a few different ways you can do it. So if you do a survey and you realize, I'm being told I'm a moderate investor, that kind of means you've got about 60% of your portfolio in equities. So another word, lots of jargon words in investing, unfortunately. Equities can be things like shares, they can be funds. And so maybe you've got some in Canadian stocks or shares, some in US ones, some in international equities, you believe in emerging markets. And then you have about 40% in cash or fixed income. So things like bonds that are lower risk for lower return. So that's one style of doing it. But the main message is if you see this and go, that's too risky for me, it doesn't mean investing is not for you. It just means you've got the wrong risk profile for your investing style.
100%, I agree with you in terms of taking advantage of, taking out that survey. So to your point, investors can go into Webroker and you can just fill out this information under the goals tab in Webroker. One thing I will highlight that you highlighted, Simran, is you are also able to see what the variation. So for instance, in the last 15 years, what the best year was when it comes to returns, and then what the worst year was as well. So while you may like the annual return, you want to ask yourself, am I comfortable still potentially holding on to my investments if the markets drop, for instance, the chart we have on screen here, by 17%? Am I still fine riding this out? One of the taglines that we got from last week's conversation was, history doesn't often repeat itself. It often rhymes. So this is where history may help you, right? History will be your friend. You're able to see, can I hold on, or maybe I can't. So that could be a great way for you to analyze if you're comfortable, using that investor profile when it comes to deciding your asset allocation. So let's say a novice investor decides they're going to continue or they want to pursue indexed investing as an example. So there are literally hundreds of investment funds out there that they have the chance to choose from. So what can they do to help decide which ones might make sense for them?
That is a really good question, and one that I also struggled with when I started, because it's amazing that we have access to resources on the internet. But if you type in, an index fund, there are so many. I often find that the best place to start, and this doesn't have to be where you end up, but the best place to start is to look at the most popular index funds in your country and the most popular index funds in the world, just to give you a sense. But most people end up choosing 3 different funds to create a portfolio. And these funds are, one will be a fund that is relative to your local market, your home country. So in this case, it might be a index fund of the top 200 or 500 companies in Canada. That's you investing in companies and home that you believe in, that you're seeing growing. Then you might put some of that money into a US international fund, or sorry, a US fund. And that might be the top 500 companies in the US. And then you might have one that is just a bond fund. So a fund filled with lots of bonds, which are lower risk for lower return, whereas the first two examples were slightly higher risk for hopefully higher return, but of course not guaranteed. So if you can put your money across three of those, doesn't necessarily matter what is in them, but if you can have those three structures, that's actually a really good place to start. And that's what we call the bogglehead method or the lazy investor method.
Yeah, so I love that you mentioned that. So taking advantage of index investing. And for those in our audience who want to learn a little more about what an index is. So essentially an index is the average of how the markets perform. So as Simran mentioned, you may have something like the S&P 500 that tracks the largest 500 companies, publicly traded companies in the United States. So if you decide you want to focus more on the US side, you could explore index funds that are mimicking those 500, holding the top 500 companies in the United States. So thanks for sharing that. Before we continue, I have a quick question for our viewers. I hope you're enjoying the show so far. And if you are, you want to make sure to subscribe to our TD Direct Investing YouTube channel. Once again, you're able to see the QR code on the bottom left of the screen. And there's a topic you'd like to learn more about, let us know in the comments. You're able to follow us as well on Instagram, so scan that QR code as well, and you're able to see a sneak peek of the upcoming shows and a ton of other content that we have designed to help you build your investing knowledge. For those of us who are logging in on YouTube Live, I would encourage you to check out the description there and register for this event and join the live conversation, because we're going to be taking questions. And so if you want to participate once again in the question and answer session, just look at the box to the right of your screen there, and you're able to put those questions in, and we will be happy to present that to Simran. All right, so let's move on to the fourth question that newbies might be too afraid to ask. So how can I avoid losing all my money in poor investments? So what would you say to a beginner who's worried about losing all their money?
I remember one of the investments that I made was a poor investment when I was getting started, and I lost a lot of money on it. It went down about 80%, and that was an individual company that I had. And when I think back to that time, what I would have done differently, because it is, I think all experiences when you're investing are good experiences because they teach you different things. And you think, well, maybe I should do this, maybe I should do that. If you think about COVID, it was, 2020. And if you had all your money in airline companies and hotel companies in 2019, you would be very, very upset when COVID hit, because airlines weren't able to, be operating and people weren't taking holidays. So your airline and hotel shares really tanked. And that's really scary. But what if you had invested in, an up and coming startup on a product or service where it helped people have calls virtually, and it was called Zoom, and people hadn't heard of it before, but now the whole world was adopting it. If you had invested in a company like that, your shares would have done very well. But you could never have predicted that. I mean, how were we meant to know? So the best way to make sure that you don't lose all your money in investing is to diversify your investments. And that's why I am such a fan, and I'll probably sound like a broken record by the end of this, but index fund investing, putting your money in a broad market fund that invests in lots of different asset classes. There's about 11 sectors when it comes to investing, whether it's things like IT or consumer goods or education. And whilst we cannot predict which sector is going to boom in the next 1 year to the next 5 years or 10 years, by diversifying, if there are losses in industries, it is okay because it's balanced out by the industries that are growing.
Don't worry, Simran. And keeping track, I think we're 3 for 3 for diversification and index investing. So yeah, I have a tally going right now. So yes, amazing diversification, absolutely amazing. It helps you balance your risks to reward. And once again, using an investor profile lets you know how much risk you're willing and able to take on. So some beginners might feel as though simply it's safer for them to just save their money than risk investing. So why do you think some people are afraid to take on risk or the risk of investing? And what's the problem with that line of thinking?
If you go to like any family barbecue or like event and you bring up the share market, there's always someone in that group, it's often an uncle, who says, "Oh my goodness, share investing, stay away from it. That is like a guaranteed way to lose money." And they'll share how they knew someone that, you know, lost everything in the stock market crash. And I always say in those instances, you should ask two questions to them. You should say, what did that person invest in? Because were they invested in a broad market fund across lots of industries, or was it concentrated in one or two companies that, well, you know, one of their colleagues had told them about as a hot stock tip? And the second question to ask them is, when the share market crashed, did they pull out their investments in a panic and, you know, solidify their losses, or did they hold on to those investments and write it out in a way that most professional financial advisors would have recommended them to do? You'll often find that if people have lost all their money in investing, they've not diversified it, and they pulled it out when it was in the red. And most people that hadn't lost money and made money through these crashes knew to diversify to begin with and didn't panic sell. So that would be my first thing that I would always share. But when it comes to the problem of going, well, I just want to save, it comes a lot from how many of us were brought up, where we got told, get a good job, have a good education, and then save your money. The issue with saving is this thing called inflation. And about 2 or 3 years ago, even the last time we had a webinar, inflation really wasn't a huge issue, and it wasn't a word that many of us knew. But thankfully or unthankfully, from the last year or so, we all now know what inflation means or have heard of it. But to put it in simple terms, if you have cash, every single year, inflation chips away at your cash by around 2% annually, sometimes more, like the last couple of years, sometimes less. And so what that means is your purchasing power, if you have $10, what you can buy with $10 today is a lot less than what you could have purchased for $10 even 5 years ago. You could have gotten 2 cups of coffee for $10 back then. And now if you need like something with oat milk or an alternative, it really starts to rack up. And so the ability to grow your wealth when you are only saving is working against you. And if you have a look at this example here on the screen, if you had $10,000 with a 1% annual rate of return, let's say you've got it in a bank savings account at a standard rate, but you have a 2% annual inflation, over 30 years, your $10,000 is worth a lot less. And you can see that over time, this is not working for you. It is completely working against you. Even though cash feels safe, you are losing money. And why would we want to do that for our long-term wealth?
Yeah, so I mean, speaking of inflation, Simran, as you mentioned, we've experienced inflation all across the world. So in Canada, for instance, inflation peaked at 6.8% in 2022, and that was a 40-year high. So everybody understands the impact of inflation. But a question I want to put forward to the audience is, tying that back to a savings account, I don't know how many of us can actually identify any savings account that paid 6.8%. So a basic savings account that paid 6.8% to actually keep you on par with inflation. You weren't getting a lot of those, right? So based on what you mentioned, the chart on screen, it shows that, you know, putting money in a savings account might actually have you, you know, fall behind what your goal might be in the long term. I also want to highlight, William said to say, don't blame the uncles. Some would say invest. So thank you for calling that out, William. Absolutely amazing. Yes, we might have some uncles that actually share great tips to get you started as an investor. So highlighting how William was able to get that comment to us, utilize the question and answer box that's on the right side of your screen there. Thanks for sharing, William. All right. So let's round out our list of questions. With the fifth question, a beginner might be too afraid to ask. Will I lose a lot of money if the stock market crashes? So, what would you say to help them overcome that fear?
If the stock market crashes, and let's say you have 10 shares and they're worth $1,000, and let's say the stock market crashes and they're now worth $800 or even lower, that can feel really scary. But what's important to remember is you still have 10 shares. Your number of shares hasn't dropped off. The value of the shares has changed. And I love looking at this graph here. This is when you're going to realize I'm quite a nerd, because this is one of my favorite graphs to ever exist. It's something that I have printed in my book because it is so important. But let me run it through it with you. This is a graph over a little bit over the last 40 years that looks at the S&P 500, which is an index fund of the top 500 companies in the US. So think of your Apple and your Amazon, your Zoom and your Microsoft, all those top 500 companies. And what this looks at is the return that that fund would give over a period of time. You can see at the very start, it starts to go up, but over time, there's many different market crashes. You've got Black Monday, which was one of the worst market crashes that we've seen in history, Gulf War, we've had the Asian financial crisis, the dot-com bubble, where like anything with a dot-com was getting poured. And it's kind of like what happened with NFTs and Web3. Everyone, all investors were just pouring money into it, obviously crashed. Wars, the GFC was huge, and even COVID. What you'll notice is at that moment, all of those saw a market dip. But the trend over time has been that they eventually come back up. That's not to say that past historical returns will guarantee future success, but over the last 40 years, if you were investing a bit of money and you decided to invest in 2005, you would be very upset if you needed that money by 2008. It would have really dipped. Within 3 years, investing is very, very risky. But if you were investing in 2005 and you were investing for 10, 20, or 30 years, you'd be very, very happy. And so what the trends show is that if you stay the course and you're investing for the long term, the risk and the likelihood of you losing all your money lowers. But if you're saying, hey, I want to invest $10,000 and I need it in a year's time, if you are unlucky enough to invest just before a crash, that is very risky and your risk of losing your money increases. So when it comes to unrealized losses, when your money is down, hold the course. This is what the professionals say. It is just hard to do in practice, because when you see that red number and you see you've lost money, you want to take it out. That is your mind playing tricks on you. Our brains notice a loss of money as more painful than we realize the gain of money. If you lose $100 and it's fallen out of your wallet, you're going to be a lot more mad at yourself than if you're walking down the street and you find $100 that, someone else has left and you can't figure out who it is. You're not as excited. So stay the course. It's the best thing you can do for yourself.
Right. And so I love that you mentioned that, because we got a tagline from last week's webinar, which was saying, when in doubt, zoom out and focus on the long term. So that ties to your point of staying the course, right? So here, if you're zoomed in, you're not able to see what the bigger picture is here. And the reality is the markets are not like a steep upward line. So it's amazing that you are able to see. As you mentioned, we will put the disclaimer, historical returns are not a guarantee, or historical events are not a guarantee for future returns. But it is interesting for you to take a look and see what has happened in the long run when you take a look at this chart. So thanks for sharing, Simran. So some investors or some beginners might be tempted to wait to invest their money until after the stock market crashes. So what would you say to encourage them to get started right away?
One of the most pivotal examples of this in my experience was during the 2020 crash. The stock market had crashed. It felt, now we look at this graph and we can see it was quite a small dip in comparison, but at the time, it was around April, March, and it had dropped significantly. And I remember saying to a good friend of mine that I was dollar cost averaging, and my dollar cost averaging happened to completely line up with the dip. So I was able to buy more shares for the same amount of money. And I said to her, I was like, hey, you should, have you been investing? You should definitely start. And she said that she was going to wait until the market dipped even further because then she'd get more of a deal. And she said, I'll wait it out. In hindsight, that was actually the worst thing she could have done. She didn't know this and I didn't know this. But within 3 months, the market completely not just recovered, but had a bull run, which meant that it went all the way up. It did super well. There was a huge rally. And so she completely missed out on any discounts that were available. And it's actually really sad. I am pretty sure to this day she never ended up investing. If you wait to time the market, it is very difficult to do. Professionals with skills and tools that are much more advanced than what we have access to still can't predict the market. And I promise you, if it was easy to predict the market, we would have all made a lot of money and we would have been retired and would be having this call on a yacht somewhere. But it is not easy. And so the best thing to do is to put money consistently every month or every week and dollar cost average your way into investing, because time in the market always beats trying to time the market.
I love that hypothetical vision of you and I on a yacht just talking about our great investments. But since that's not the reality, dollar cost averaging is a great way, as you mentioned, to average out when it comes to like taking advantage of the dips and rises in the market. So for investors who are looking to learn more, we actually have a great video on dollar cost averaging. So you're able to check that out on our YouTube channel. And if you want to find out where that channel is, you can scan the barcode that is at the bottom left of the screen. All right, so let's move on to our next segment, Simran, and I hope you're ready for this. We like to call this Chart Smart. So we're going to highlight a chart that our guest speaker feels is particularly interesting or informative, and we want you to explain why that is.
Well, if you have a look at this chart, it looks very similar to the chart we saw earlier, but in theory, what it means is if there was a person, let's call him Rob our uncle. I apologize to the uncles today. I don't know why I'm feeling anti-uncle this morning, but let's say he decides to invest $1,000 a few times over the course of the last 40 years, 2, 3, 4, 5 times. But he has the worst timing in the world, and he invests right before 5 of the biggest market crashes. Unfortunately, that's just really bad luck. But if he decided, because, uncles still know a little bit, he decided that he was not going to get rid of his investments and he was just going to hold on to them. If he held on, you can see all the way at the very end in the light blue box, he would have $5.7 million by the end of May 2020 with a total, and this is insane, a total of 1,332% return for the worst timing in the world. So this kind of highlights the importance of, if he saw those dips and freaked out, he would not have made that return in the end. It's all about, again, staying the course, trying not to time the market, but it all works out in the end if you are investing for a long period of time. The risk of losing all your money decreases the longer your portfolio timeline is.
Yeah, I love that you mentioned that, because when it comes to things like trying to time the markets, so the best days in the markets actually happen during a bear market. And to your point, you mentioned, a friend of yours who was waiting for the markets to dip a little more, hoping to catch one of those best days, but actually ended up missing those best days. And studies have actually shown that if you miss 10 of the best days in the last 20 years, your annual return is actually about half of what a person who just stayed the course. So yeah, so just something to keep in mind when you're thinking about investing or dipping in and dipping out of the markets. So we're going to have to leave the interview portion of our conversation there, but we're not done yet. We're going to open the floor and take questions from our viewers. So I want to encourage you, if you have any questions, fill that box out on the right side of the screen. If you're on YouTube watching this live, check the description box there. You are able to see how to register and join our conversations. So Simran, are you ready to hear what our audience wants to know more about?
I am so excited.
All right, awesome. So let's start off with a question. And this question is from Teresa. Thanks for asking, Teresa. So Teresa is saying, what preferences do you regularly read or refer to build your knowledge base of companies in order to make the decision of whether to invest in them or not?
Oh, that is a good question. I would say if I was to start out again, I like reading the news, the general news across different countries and different platforms. So this was a skill that my dad really got me into, which was really helpful. He'd say, Simran, every morning you should read one paper, and I don't read the paper, so I read it on apps, but one app from your local country, one from an international one, maybe in the US, and one that's from the UK. So I like to read a little bit about what's happening in the world across different countries because I like looking at investing from a sort of macro view of what's happening in the world and what are the trends that we are seeing, and therefore, what are the kind of companies that would be interesting. So that's a really good general way. If you get into the habit of just having a look at what's going on in the world, you'll realize that that relates to trends a lot easier. Then when it comes to making a decision of companies, there's a lot of free resources and tools. And I actually really, really love Yahoo Finance because it is not connected to, Yahoo Finance doesn't have a fund at the back end of it. So it's completely unbiased. And I'm pretty sure Yahoo Finance is like one of the only legs of Yahoo that is still standing. But it works really well because if you type in a company's name, like Apple, for example, it will give you the information of the returns it has made, the financial markets. It will give you the balance sheets over the last couple of years. And more importantly, you can even look at things like its ESG or sustainability rankings. So that's just a fancy way of saying, does it meet the requirements of being an ethical company? Or if you're looking at a fund, what's invested in the fund? Does it include weapons? Does it include tobacco? Does it include the things that are important to you? So putting those two together is a great way to get started. And also, I really enjoy just passively learning from where I am. So if I like listening to podcasts, I'll find a financial podcast. We have the Girls That Invest podcast, of course. If I'm on social media, I like following a few accounts that like talking about general news and investing. And of course, we talk about that too on the Girls That Invest Instagram. But there are lots of amazing ways of learning. It's not just the news. I think if you're an auditory learner, podcast, visual learner, book, if you like watching YouTube's, like, this is being streamed live. So it's a little bit of everything, but there's not a one-stop shop that I have found that gives me everything I need.
Yeah, I like that you mentioned social media because right now social media is huge. It's good to keep in mind that you are getting information from reliable sources. We do have a webinar coming up October 24th. And that webinar is going to touch on, how to filter out, information when you are using social media. But to your point, Simran, there's great social media platforms out there or channels like your podcast. We have a presence on YouTube as well. I also want to highlight, if you have an account with TD Direct Investing, if you go into WebBroker, you have access to some of these great conversations that we've had with industry experts. You're able to attend some of our master classes, which are live interactive sessions with experienced instructors. You can ask really great questions there. We also have, there's really great analyst reports that you are able to explore in there as well. So there's a great wealth of educational resources out there, reliable educational resources out there that would help you as you get started on your investing journey. All right, so let's move on to our next question. This question is from Kira. So Kira is saying, how much is a good buffer to keep in your checking account if you're already allocating a good amount towards your retirement or tax-free savings account and your emergency fund?
Oh, I like this. I actually don't keep a large buffer in my checking account. My checking account is usually My checking account is usually what is left over for me to spend during the week. So when I get paid, my money gets put into different accounts automatically. I have an automatic transfer. So some goes into investing, some goes into an emergency fund account, some goes into a long-term savings account, and some goes into a separate bills account. So for my mortgage and for, electricity and utilities that I pay for. So whatever is left in my checking account isn't a buffer, is more like, hey, Simran, you have maybe $100 or a few $100s to spend. And once that declines, I am eating at home for the rest of the week.
I love that you're sharing that. So thanks for being honest and sharing that with us. All right, we have a great many questions here. So we're going to move on to the next one. And this question is from Ho. So Ho is saying, when the price of a stock drops, should we add more money in it or sell it? What would you say, Simran?
My experience with investing and my theory of how I like to manage my money is that I do not sell a share. Most of the time, my money is kept in index funds. So I don't have many individual companies. Maybe less than 5% of my portfolio is in these individual stocks. I would say that I don't sell them until I reach my goal. So I decide, hey, you know what, I'm going to invest so that I have a nice nest egg for retirement. So when I am ready to retire, that is when I sell those shares. I'm not a big fan of buying and selling speculatively on the hopes that I'm, reaching some trends. If a price of a stock dropped and I really, really valued that stock and I thought this is going to do well, and yay, it's cheaper, it's on sale, sometimes I will add in more money, but oftentimes these are when funds drop. So during March 2020, the share market dropped. I had my usual investments that were my dollar cost averaging, and then I put a little bit more money in just to, buffer that out. But I didn't sell anything. And I think trying to buy and sell quite often actually isn't the best thing to do in my experience, because it increases your risk of now you have to start paying a lot more taxes and capital gains taxes because you're trading your investments versus being a long-term investor. And most governments, with the way that they look at tax, is if you do not sell a share for more than 12 months, your tax lowers when you do eventually sell it.
All right. Awesome. So we have another question from Brigitte. And so let's take this from the perspective of, a young new investor. So the question says, should we focus our investments on dividends?
Oh, this is a good question. This was something that I considered myself when I was getting started, when I was studying investing. When you look at investing, there's two ways to make money: capital gains and dividends. Capital gains is when you buy a share of, let's say, company A, and you hope that it goes up in value over time. And then when you sell it, the difference in the share price to what you paid for is the cash you get. Versus dividends, where if you buy a share of company A might give you a 4% dividend. So for every dollar you invest in them, you might make 4 cents back. Dividends are important if you want cash flow, but a company that gives a lot of dividends is giving you dividends because they're not taking that cash and putting it back into growing themselves as a company. So oftentimes banks or insurance companies, they're more stable. They're not going to grow quite quickly, so they might give you dividends. But on the end of that, they're not going to go up in value much by their share price. On the other hand, a company that is trying to grow really quickly and have a larger capital gain won't be giving you dividends, because any money they have, they're going to put back into development, into research. We call those growth companies. If you are a young person, you have more time. So if you want to have a larger nest egg, maybe you might prioritize capital gains. But if you're just looking for cash flow and you don't mind your shares not going up as much, and you're just trying to live off your investments, and you have a lot of money to invest to begin with, then dividends might be an option. But most young people don't have, $10,000, $20,000 to start with. So they tend to focus on capital gains. And then as time goes on, they move to dividends.
Thanks for sharing that. All right, so let's take another question, and let's look at this as well from the perspective of somebody who's totally brand new to investing, who's just getting started. So Neha is saying, what steps should I take to start investing today? Thanks, and thanks for your question, Neha.
I think the first step is to open up a brokerage account. Once you've got that set up, you're going to decide how much you're going to invest. So it might be $20 a week just to start with, just to dip your toes in. Maybe it's $50 a week, whatever you're comfortable with. If you've got a little bit more, maybe even 100. And you're going to choose, just to begin with, one fund to invest in. You're going to do that based on the type of investor that you are. So we're going to do the risk profile survey that was mentioned earlier. And then you're going to go, okay, it's given me an idea of where I should invest, put the money in, set up an auto payment, and don't look at it for a month. Just let it exist, come back, and you'll see that it might have gone up a little bit, it might have gone down, but it will give you a better idea of, can I handle how much it's doing this? Do I need to have a less risky investment style, or do I need to have a more risky investment style? And I have to say, the one thing that I have found that has really worked is do this with a friend or a colleague, because then you start comparing your investments with each other and you have an accountability buddy. It's like going to the gym. If you know that your friend is waiting for you at the gym at 7 a.m., you will show up. But if you're just going by yourself, it's a lot easier to go, oh, I'll go tomorrow. It's not that important.
I like that idea of an accountability partner. So it's really great to have somebody in your life who's setting goals as well, and somebody you can lean on when you have questions. So thanks for sharing that, Simran. Really great questions we're getting here. So we have a question from Isabel. Isabel is saying, I've been investing for 5 years. My portfolio is made 100% of Canadian shares. I'm afraid to buy international stocks because I'm not familiar with those companies. How important is it owning international shares as well?
There is a term for this, and that is called home bias, where we invest in what we understand. And that's a really good place to start, because these are the companies that we see, we drive past, we purchase from, or we know of, and they kind of passively come into our sphere based on the news and the things that are being talked about at work. However, home bias is not a good thing, because it means that we believe that where we live has the best options available. And so I believe that you can manage this by continuing to invest in the companies that you are in, but also opening yourself up to diversifying your portfolio. You don't just want to diversify based in your country, but also other markets. I see what you're saying in terms of, well, you're not familiar with companies from overseas, so how do you know if they're good or not? You can manage that risk by, rather than trying to pick and choose companies, maybe you look at a fund. There's some funds that are international funds that literally invest in thousands of companies all around the world, with a bit of a concentration in the US, or you can choose one without any US concentration. And that's a really good place to start. And you might maybe only put a small percentage of your investments in that, just to expose you to an international market without taking on a risk that's maybe a little outside your comfort zone.
So this ties back to your point, Simran, of diversification. You mentioned that again, so I think we're 5 for 5 there. So I hope you got the answer you're looking for, Isabel, and that's amazing. So we're going to have to leave the conversation there, Simran. I want to thank you so much for helping us answer questions, some of the top questions that beginners might be too afraid to ask. So hopefully we've given those in our audience the push that they need to get started. Do you have any final thoughts you'd like to share with our viewers today, Simran?
Firstly, thank you for having me. It's been absolutely amazing. And the questions here have been so, so good, and clearly such an intelligent bunch that have joined in. If you noticed, throughout the entire conversation, the same words came up: diversification, buying and holding, dollar cost averaging. And if you have those 3 topics down, you're probably ready to be an investor, and you're probably ready to get started. One of the biggest things that holds people back is they think that there's so much they need to know and they need to learn it all. But like I said at the start of this conversation, you do not need a degree in investing to be an investor. Everything you've learned from this conversation, you've been here for almost an hour now, is actually enough to take the leap.
All right, so thank you again for joining us. I want to thank all our viewers who tuned in, took the time to ask us questions. It's been really amazing having you. Now, I do want to mention that if you have any feedback about today's session, you are able to share that with us with the highlighted box on the screen there. So fill out that survey. Let us know what you loved about today's session, what more you'd like to see when it comes to our content. As I mentioned, the month of October is all about you, investors. And so I would encourage you to register for the rest of our upcoming events. You're able to find those. They should be highlighted right now on your screen. Register for those and join the conversation as you did. So you are able to find any events that you may have missed. You can find that on-demand content in the Learning Center and Webroker and on our YouTube page. I want to thank you all so much once again for tuning in. See you all next time.
Have more questions? Check out the links to the right and in the description below.